Recently, I've been thinking a lot about passive investing, and since there's so much information online, sometimes it could be overwhelming to get started. So I thought it would be fun to film my first investment in the stock market of £1,500 and also talk you through where I've decided to allocate and why. If you're really new to this, you've probably heard of a lot of benefits of investing, but also a lot of risks. The main benefit that everyone always talks about investing is that it can basically make you rich. I mean, that's not 100% true because you need money to start with, but it definitely can be like another stream of income. If you invest correctly and you diversify correctly, which we're going to go through later, then you could definitely make some money back. Just a disclaimer, I'm also very new to this, so this is definitely not financial information or anything. It's just meant for educational purposes, and also let me know if there's anything else that I've missed out or I should keep looking at. I'll definitely be interested in like hearing more things. So I've dabbled in trading a little bit here and there, Bitcoin investments, and I also worked in finance, but I wasn't allowed to invest while I was in finance. Most recently, I read the book Think, Act and Invest Like Warren Buffett, which really helped shape my perspective. Warren Buffett is obviously one of the richest guys in the world through investing, and also this book helps to give you an idea of what kind of portfolio split you would like that could help you get started. So I definitely recommend that, and I'll put a link in the description box too. Also, I've watched a bunch of YouTube videos on this, so I'm pretty much a professional. Okay, just kidding. No, seriously, this is not financial advice, so yeah. If you're still not convinced by investing, then open up a compound interest calculator right now. Go and check how much money you can afford to put in every month for the next 10, 15 or 20 years. Put in around 8 to 10% annual return. Obviously that will vary depending on your portfolio, but you could definitely find that, if not better. And check when you'll be rich. Finish this video and thank you later. Okay, so I'm first going to go through the investment strategy that I'm going to use. Then I'm going to go through the approach that I and many investors do use called cost averaging. Then I'm going to give a quick background on ETFs and index funds, since those are the funds types that I'm going to be investing in. And finally, I'm going to talk through the 3 funds that I'm putting in my £1,500 in. So you could have a look at that. Investment strategy. First off, you need to understand how much risk you're willing to take. Are you going for high risk for high return or low risk, low return? Different people feel comfortable with different things. I think the younger you are, usually people say the more risk you could take because you theoretically have more time to make back any losses through an economic or financial crash that could come when you don't expect it. Obviously, we can all die tomorrow, but that's just like a common theory that people go for. Also, that depends on how much money you make, maybe. So if you can afford to live on less and invest more, then you might be willing to have more high risk, but it all depends on your personal situation and it depends on your comfortability. And I'm not going to go into too much detail, but essentially there are 2 types of investing. That's passive and active investing. Active investors try to time the market, so they'll see, for example, today Apple stock is low, they could buy it today and then tomorrow will increase and they sell it, so buy and sell really quickly so that they can make the short-term profit and the short-term gains. Kind of like in Wolf of Wall Street. I'm pretty sure everyone probably grew up thinking that investors, or maybe traders specifically, were like that or are like that. Passive investors care more about time in the market, so forget about the fluctuations on a day-to-day basis. They don't care if the stock's up or down by 1 or 2% on a daily basis, but we're talking 5, 10, 20, 30, 40 plus years. For active investors, it's more the short game. For passive investors, it's more the long game. A funny story is that in 2008, Warren Buffett, the well-respected investor billionaire who this book is about that I mentioned earlier, he made a £1 million bet with the hedge fund industry, saying that the S&P 500 would outperform any hand-picked portfolio that they did, including the fees and expenses and all of that, with the S&P 500 being a list of the top 500 US companies. 10 years later, he won the bet, which basically helped to prove that passive investing can yield the same, if not better, results than active investing. Okay, so we've touched on investment strategy. Now let's talk about cost averaging. If you were to open an investment app or a company's shares on the stock exchange right now, you'd see that it's either up or down. Ideally, you want to buy when low and sell when high, because that way you get more value for your shares. You might think that waiting for the market to crash so you could buy them at that time so that the shares are better value would be a good idea, but because we don't know when there's going to be a market or an economic or financial crash that affects the markets like this, it's better to average out your investments, because essentially that's all you could do without trying to predict. Cost averaging is when you regularly put a certain amount of money per week or per month, regardless of the market condition. Then by the end of the year, when you take the average of how much you put in and the value of the shares that you got them from, ideally you would have had the best that you would have done if you were trying to predict the market. Theoretically, this way reduces investment risk, and that's why it's safer, and that's why a lot of people use it. There's obviously pros and cons to this, but if you're just getting started like me, it's probably the easiest way just to force yourself to get started instead of getting too worried about the fluctuations that happen on a day-to-day basis. An example of this would be Coinbase, the cryptocurrency trading broker, saying that if you were to buy Bitcoin every week for the past 5 years, that would have performed better than trying to time the market 82% of the time. Now let's talk about where to start. This is another thing that can make it so easy for you to postpone and hard for you to get started. Like, what is literally the first thing you have to do? Get a brokerage account. There are so many different types of broker accounts, and it's kind of annoying because everyone always says find the one that's best for you. And until I started researching, I didn't realize that there are actually small and subtle differences between them all that honestly nobody could tell you which one to pick. Here I went for Vanguard because the ones that we decided to finalize, I decided to go for Vanguard funds, so it just seemed like the best place to go for it. It's also very well respected. There are cons to it though. You can't invest in individual stocks, I believe, and a lot of other things, but I also opened up a Trading 212 account, which I'm going to use later on, but taking it one step at a time to start with. Also, not all brokers have the funds that you want to invest in, so it could also be a good idea if you want to have a quick background on which funds you want to invest in and just get an idea of which places you want to put your money in. Do you want to do dividend stocks? Do you want to invest in individual companies? Is there a big broker that has access to all of these? For example, there was one account that I didn't want to use because they charge you every month that you don't invest, and I don't want to get charged for that just because, I'm doing it for the long time. It is really important to consider the fees and the structure of each app though, so make sure you watch at least 15 or 20 YouTube videos about it before. That's what I did, and I finally managed to narrow it down. You also need to make sure you're looking for your location. I live in the UK, and a lot of people are from the US that talk about this stuff, so yeah, try and just narrow it down based on like a lot of research, which is the best thing I could tell you, and it is quite an annoying thing to say, but it's true. To round it up, I'm going to be cost averaging my investments. This is just going to be my initial kind of like my initial payment or initial deposit or whatever, just to get the ball rolling. I'm also going to be doing passive, and it's a long-term strategy that I'm going for. In terms of asset class, it's quite risky because I've chosen mostly equity funds. It's better to usually diversify a bit more, better to have different asset classes so you can lower your risk. But like I said, high risk, high reward, low risk, low reward. You just need to choose whatever's best for you. I'm going to start talking about my specific investments, and I'm going to try and explain a bit more background so it can help a beginner. All 3 of the funds I chose are all equities, which is typically more risky than bond. Also, since I've gone for index funds and ETFs, I believe that this helps narrow down the risk a bit, and I'm going to explain that in a second. In short, index funds and ETFs are like a tracker that follow a market and a list of companies, for example, the S&P 500 or the FTSE 100. The companies behind the funds also play a big part of the fund's reputation. An index is a list of the market or subsections of a marketplace. Index funds act as a pool for thousands of people to invest in one open-ended fund, and they offer a good deal of liquidity since you could buy and sell as you like. An ETF is kind of like a fund and a stock at the same time. It acts like you have ownership in an individual company, and you could buy and share stock on the stock market. The great thing about index funds and ETFs is that it gives you the opportunity to perform just like you own a part of each of the companies on the list. The good thing is when they're all put together, you reduce the risk of you just having ownership on that one company, and therefore it's better for diversification and, limited investment risk. Typically, when we're looking for a fund, we want a large fund like in the billions. We want cheap prices, and finally we want low expense ratio and other fees in general. Expense ratio is the percentage of the fund that's used for maintenance of the fund, admin and things like that can help manage it. Honestly, it sometimes feels like there's so much information. People get FOMO from not being social, and I'm out here getting FOMO from investment opportunities. Now I'm going to go through the 3 funds that I invested in. I put £500 in each of them, and I think this is a good start, but like I said, I definitely need to diversify more, so just keep an eye out for that. The first one I've gone for is the Vanguard S&P 500 ETF with the ticker VUSA. This is a very popular fund that follows the S&P 500 that we talked about earlier. It has a risk ranking of 5 out of 7, so that's closer to the top end, which is higher risk. It has an extremely low expense ratio of 0.07% and a total number of stocks of 505. It's a very large fund with a total assets of $27.4 billion in dollars. You can compare the past performance every year by looking at the net asset value of the fund compared to the benchmark it's tracking. If we go into the price and performance tab, you can see the price analysis over the past 18 months. There was a dip in March last year, which was obviously due to the uncertainty at the start of the pandemic. You can also see it's been on an upward trend since its inception in 2012. Now, if we see the portfolio data, 100% of the stocks are in the US, North America region. The equity sector diversification includes a lot of different industries, but around 27% of the portfolio is in tech stocks, which is expected since they are the biggest companies like Apple, Microsoft, Facebook, Google's parent company, Alphabet. You can look at it in more detail if you like by going through it on the website. The second one I've gone for is the FTSE All World UCITS ETF with the ticker VWRL. For the sake of global diversification and optimism in the long-term world economy, I've gone for this index. It has a risk ranking of 5 out of 7, similar to the other one, and a charge of 0.22%, which is still very low relative to other funds. It currently owns 3,461 stocks. It has $6.6 billion of total assets and measures large and mid-cap stocks. It's also on an upward trend as of the last 18 months, but was impacted in March last year, similar to pretty much the rest of the world and all the stocks in general. In terms of the portfolio split, 58% of the stocks are in North America, then 17% in Europe, and so on. So it's not technically a complete all-world index. It does have different countries, but the percentage are not split evenly. It does have a small percentage in many different countries though. Also, similar to the other one, the highest sector is in technology again, with 22% of the portfolio being tech companies. So the final one is the FTSE Emerging Markets UCITS with ticker VFEM. Off the bat, this is the highest risk out of the three I've chosen. The risk is high here because not only is it a 100% equity fund, but also because of the geographical location, given they're in emerging markets. Another thing that can increase the risk ranking is that many companies are relatively unknown. I've definitely got hope that the emerging markets will over time continue to thrive, but of course many companies might not, which is potentially a reason for this risk. This also has a low charge of 0.22% and a total of 1,818 stocks right now. It's smaller than the other two funds with total assets equaling 2.4 billion, but it's still quite large, which is pretty good. This index is designed to measure equity market performance of large and mid-cap companies in emerging markets. As for price and performance, there are slightly more price fluctuations over the past 18 months, but there is an upward trend overall, which is good to see. As for the portfolio split, China holds the highest allocation at 44%, then Taiwan, India, and so on. But it's good to see that there are a lot of countries to help with diversification. So yeah, those are the three funds that I decided to go for. I think it's a good start. I definitely know that I need to be diversifying a bit more. I'm really excited to continue with this journey, and I would love to hear if anybody's got more tips and advice, like I mentioned. Hopefully I'll continue to see it grow and just to see how it all works out. So thanks for watching, and if you like this, please don't forget to like, subscribe, and comment.